Hello everyone. All asset classes perform in cycles. Buy low and sell high is the holy grail of investing. Unfortunately, this is extremely difficult to practice due to the human emotions of greed and fear. Most investors understand the long-term compounding nature of an asset class like equities. However, the first instance of a fall, investors then start comparing with the safety of a fixed deposit. Volatility is seen as a bad word, but one can't wish it away. The way out is to rely on a model which reduces these emotional biases and which bring in discipline as well as agility to benefit from the ups and downs of the market. Kotak Balanced Advantage Fund attempts just that. Let's take a look at how Kotak Balanced Advantage Fund functions. Kotak BAF is an equity-oriented dynamic asset allocation fund that has four broad asset classes. 1. Net equity. These are businesses that the fund invests in on the basis of its long-term business potential. 2. Arbitrage or hedge equity. To benefit from the equity taxation of the fund, whenever net equity as suggested by the model is lower than 65%, the fund engages in arbitrage. That is, buy in cash segment and sell an equal amount of shares in the futures market at the same time. 3. Debt in the form of fixed deposits. To undertake these arbitrage transactions, we retain some portion of the fund as fixed deposits that are posted as collateral at the exchange. 4. Debt in the form of fixed income securities. These broadly comprise approximately 20 to 25% of the fund. Let's now see how the model to determine net equity works. The Kotak BAF model works on a two-factor basis. The first factor is valuation, which is measured by the trailing price to earnings ratio of Nifty. Over the last 25 years, the Nifty PE ratio has varied from 10 to 30 approximately. For each band of PE ratio, a broad range of net equity is determined by the model. To then arrive at a precise point of net equity, the model uses the second factor called market sentiment. This factor is evaluated using various variables like long range rolling returns, near term market volatility, breadth of market, etc., etc. To give an instance, for example, Nifty has in the long range given returns more in the range of 12 to 14%. Hence, if say the last 5 to 7 year returns have been subpar, say at 5%, one needs to be a bit more aggressive on equities now. An interplay of both these factors give a precise number of net equity. This model is run on a daily basis. This ensures that the fund can be agile to large moves that happen on a daily basis in extremely volatile times. Let us now see how the fund has allocated net equity over the last 12 months. There have been broadly two phases where Nifty has moved by more than 10% in the last 12 months. The first such move happened in September and October of 2018. During this phase, Nifty corrected from 11,700 levels to 10,300 levels in a span of about 40 days. The net equity in the fund reduced from about 34% to about 25% in late August and early September. Then subsequently, as the markets corrected sharply, the net equity moved up from 25 to 52% by early October. Subsequently, markets retraced the fall and went back to 12,000 levels in May of 2019. The net equity of the fund then reduced to 36%, thereby booking profits of this big move. The second such correction happened in July and August of this year. The fund reduced its net equity exposure to about 28% in early July, and subsequently, as the markets have corrected, we have increased net equity to approximately 36% as of July end and have subsequently increased it further to about 44% in mid-August. This discipline of reducing equities in an overall exuberant environment, and adding equities aggressively during periods of panic is what helps the investor to benefit from volatile markets. We have seen in most years markets provide such opportunities, and hence such a discipline benefits from this heightened volatility. Within the net equity part of the fund, we have invested primarily in diversified businesses across sectors and themes with a large cap bias currently. Currently, mid and small caps account for about 20% of the net equity portion of the fund. Key sectoral bets currently are the gas sector, cement sector, corporate and retail banks, and the technology sector. The debt portion of the fund is invested in a very conservative manner to provide stability to the fund, investing thus far in relatively low duration and good quality credit paper. To sum up, the Kotak Balanced Advantage Fund attempts to reduce the emotional biases of greed and fear by a model that takes into account valuations and market sentiment. Valuations in the market is a part and parcel of asset class like equities. One needs to embrace this feature rather than worry about it by proper asset allocation, and Kotak Balanced Advantage Fund can be a key tool to help investors achieve this. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.